Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to episode number 82 of That Annuity Show. With me are my regular co-hosts, Will, welcome.
Good to be here.
Mark.
Good morning, Paul.
Hey, and Ramsey. Ramsey, how are you?
Fantastic. Great to be here.
Yeah, well, great. Well, listen, I'm very pleased to have a very interesting guest on our program today. And we have somebody all the way from Texas on our show. Charles Sizemore is the Chief Investment Officer of Sizemore Capital Management, a registered investment advisor based in Dallas, Texas. Welcome, Charles.
Thanks for having me.
Hey, well, interesting time. We were just chatting before the show, and it's a bit distressing today. You can't turn on on your television, open up your smart app without a lot of news coming from Washington these days. And I think we expected turmoil after the election. I don't think anyone expected what we're seeing from there. And Charles, perfect, timing for an article you put out. The blue wave hit Washington. How to invest now? And just maybe talk to us about a little bit about your business, and then talk to us about your perspective on how we settle our clients and how do we keep them on the right path here.
Yeah, sure. So my firm, Sizemore Capital, specializes in building portfolios that ideally zig when the market zags. We like to build alternative strategies that complement traditional strategies. That's the idea, is that portfolio that just doesn't bounce around that much. But onto that broader question of what do you tell clients today? What do you do in this environment? I think more than anything, it's important to remember that we have data. We're not really stabbing in the dark here. Over the last couple hundred years, and I would say in particularly over the last call it 70, the years where we've really had a functioning stock market and the economy looked somewhat similar to what it does today. We've had Republican administrations, we've had Democrat administrations, we've had Republican administrations with Democrat Congresses, we've had Democrat administrations with Republican Congresses, we've had blue waves, we've had red waves, we've had it all. And what we found is over time, politics really don't matter all that much. Stock returns, they matter, sure. Individual policies can matter, they can affect industries. But whenever anybody tells you, so-and-so just got elected, well, there went my stock portfolio. That really hasn't happened in modern history. And I don't expect that it will going forward. So I think there's a lot of noise that really does need to be filtered out.
Yeah, Charles, most definitely. I think we're all hearing it. So people are, concerned. And I think your perspective is helpful to remind folks that this isn't the first time we've had a transition of power. For some reason, in particular, this transition, I think, is for a lot of reasons, is garnering a lot of attention and focus.
Sure.
Charles, what about the impact of taxation from different administrations? Does that have a big, weighting in terms of your recommendations on dividend stocks or non-dividend stocks and the structure of portfolios?
Well, sure. So tax policy can definitely affect, how you invest. I would say, the bigger picture is we had, great stock markets in the 50s and 60s when tax rates were comparatively very high. So low taxes versus high taxes, that's not this binary thing where, low taxes means automatically high stock returns and, high taxes means automatically low stock returns. But it does affect how you trade. For example, if let's just say, short-term capital gains. Yeah, well, actually, a fine example. Normally, you do try to keep, shorter-term capital gains generating strategies in IRAs if possible. That's just smart. You put the more tax inefficient things in IRAs. You put more tax efficient things like index funds. Things that you don't trade that often. You keep those in your taxable accounts. That hasn't really changed. If taxes do go up, And it looks like they will on corporations and on higher income individuals. It looks like that is likely. Now, again, I don't think it's going to be this catastrophic, life-ending tax hike. It's going to be a couple percent. I don't want to pay it. You don't want to pay it. Nobody does, but you do have to sort of keep it in perspective. But to the extent you can shift your assets around to put the more tax inefficient stuff in IRAs, it only makes sense to do that. And it makes sense to do that more now than ever.
Yeah. So my daughter just got her $600 stimulus. Okay. Now let's fast forward to February. Imagine the $2,000 check comes. Charles, oh my gosh, inflation. Do I have to worry about inflation, this spring?
Short answer is yes. Longer answer is probably not this spring. And I know, look, you're thinking, how could there not be inflation? You're dumping money out of, well, not literally dumping money out of helicopters, but proverbially dumping money out of helicopters. How does that not lead to inflation? Well, look at some recent history. If all it took were massive budget deficits and, just spending like a drunken sailor on shore leave, if that's all that took to generate inflation, then Japan would have the highest inflation in the world. And they don't. Japan has been struggling with deflation for the last almost 30 years now. And up until very recently, Japan's annual budget deficits were just head and shoulders above every other advanced economy. And they couldn't generate inflation to save their lives. So I would say it is likely we eventually have inflation, particularly if we continue down the path we're on. But I don't think it happens in the next couple months. I mean, you do see inflation popping up here and there. You see it in home prices, for example. But broad-based consumer price inflation, I think that's still a ways off. I think that's probably at least a few years away.
So you mentioned the Japan story, and obviously there's a probability of a number of different scenarios happening, but I think in this country, we're not used to this idea of potential deflation, whether it's the Japan example or even in many ways what we're seeing in Europe. I'm wondering, what do you think the likelihood is of a sort of a global Japan story, like a global sort of deflationary, sort of secular trend towards deflation over time?
We're sort of there, honestly. You look at what's happened in the world economy since 2008, and I would say it's sort of a lighter version of what happened in Japan. Japan's sort of a special case. They have a shrinking and aging population, and it's a very insular economy. And you can go on all day about how Japan's a little bit different, but I would say globally, we really have seen something of a Japanese situation in the entire developed world.
Yeah. Now we obviously are very focused on the needs of seniors, 55, 60 up. Bond yields horrific. We know that as a carrier. What happens when seniors say, "Look, uncle, the market, no matter what happens, the market's gone up." We literally see riots. What happens? The market goes up. Time to pull out all my. Is it time, Charles, for me to pull out all my fixed instruments? Take the coupons, get rid of the certificates and put the money in the stock market. Do you see retirees doing this in mass? And does that just create an even worse problem for yields over the next few years?
It is kind of crazy. I've had clients that were very conservative, just very straight-laced. I don't want to lose money. I just want my steady, quarterly check. And I want no risk or minimal risk. In the last couple, call it 18 months, they've really developed an appetite for risk. These are clients I've had for years. I've never seen them, have a risk-taking bone in their body, and all of a sudden now they're wanting to buy Bitcoin or something. And so it is interesting. I mean, that worries me a little. It tells me, hey, we're probably kind of at the end of a bubble, But with respect to what that means for bond yields, let's say we are in a bubble situation, kind of like the late 90s, something like that. And let's say that stocks do really push higher, and then eventually, what happens to bubbles happens. It breaks. that should actually be good for bonds. I know as low as bond yields are right now, they actually can go lower. So I would say if we do have some instability in the stock market, those bonds are going to be looking pretty good. But I would say that is a big, there's the systematic risk and there's the individual client risk. The individual client risk is that a lot of families end up taking more risk than they really should, and it doesn't go well for them. And then systematically, you have this problem of, okay, well, if you have a lot of families out there, a lot of seniors that panicked because they saw how low yields were and they reached for returns by taking too much risk, well, then you really have a problem if you have a bunch of impoverished seniors. So this is going to be a tricky couple of years.
So how do you talk your clients through that? Like that's a real ongoing trend. We had David Blanchett on last week, and he talked about the search for yield will continue, and it leads to exactly what you're talking about. And so, you're at the front line of those discussions with customers and helping them actually sort of walk them off the ledge. How do you do that?
It's tough. I mean, the first thing you have to do is manage expectations. When they tell you, well, I used to get 5% in a CD, I mean, you have to be sympathetic. You have to tell them, hey, I get it. I mean, I remember those days, but they're not here. Like that's not the world we're in right now. We have to kind of accept we have to accept, the options on the table in front of us. And, what are those options for income? You can throw a few bonds into the mix for, volatility reduction, sure. But if you're looking for yield, you can still get, 3 and 4% yields and a lot of good dividend paying stocks. You can get, slightly better yields in real estate investment trust. If you're willing to take a little bit more risk and kind of go out on a limb, energy pays a little bit better. The yield is out there without really reaching aggressively for it. And it is okay to reach a little. In a good diversified portfolio, if you have a portion of it dedicated to kind of more exotic, reaching for yield scenarios, that's okay. You don't want to put your entire portfolio in something like that. That's when bad things happen.
Hey, Charles, you mentioned earlier that there's some clients that you historically may have had some aversion to risk are now seem open or more receptive or willing to accept some level of risk. What do you attribute that to more recently?
Well, you could go on and give lectures at a university as to why people's risk profile changes. I'd say it's a couple things. One is crowd mentality. As we've seen just recently, crowds can do strange things when they get agitated. And that's true in financial markets as well. And it kind of ties to that fear of missing out. If you are really conservative and you are happy with your conservative income investments, but that neighbor you never really liked, that guy was always kind of an idiot, but now all of a sudden, he's making 3 times my returns. Well, that's not right. I mean, this guy can't be making more money than me. I need to make more money than him. So I'm going to do what he's doing and even more. And so that mentality kind of sets in. And so, what do you do with that? That's a dangerous mentality.
Well, I bought the Tesla. I should have bought the stock. Wow. Right. I wouldn't be on the podcast here, Charles, if I'd done this, right? Mark, you're a car guy.
You might have a garage full of Teslas that you were playing with.
Yeah, it might have, but it just, sort of continue on that thread that Will pulled here. Look, if Charles, I've had it. I've had a safe portfolio, tech, right? Now, policy, right? What's a real policy change? What's not a real policy change that will happen? We had a great discussion with Barbara Matthews, who's got a very interesting, model for, again, separating noise from what's actually happening. Well, just in the last 2 days, I've seen a Wall Street Journal article saying, let's break up big tech and then I've seen New York Times saying the very same thing. Now, wait a second, for very different reasons, for very different perspectives, but with the same goal of saying, look, these tech companies are too big. Do you see those policies shifting sectors where more conservative investors shouldn't be going right now?
It's funny. We really do have a conservative system. And I don't mean that in any sort of political way. It's conservative in that it's really slow to change. And antitrust suits are very rarely successful in doing what they want to do. I mean, I think you really have to go back to the Teddy Roosevelt administration to find a strong, robust approach to breaking up companies. I guess, Ma Bell breaking up into Baby Bell is another example, but there really aren't that many, right?
Well, and that one took years. That took
It took
years to play out.
Exactly. Now everything moves a little bit faster these days, but I think our system was designed to cool the passions. We don't have a system where quick action is even possible, and that's by design. So by the time you get any sort of momentum behind breaking up big tech, the companies involved may not even be as relevant by the time it actually happens. But I do think this points out why you should always be diversified. You shouldn't put your eggs all in one basket. It's great if you put all your eggs in Tesla and you've made 10 times your money in a year, sure. But let's say you have a really tech heavy portfolio, and this time, let's just say I'm wrong, and the government actually does agree that they're going to either break up or put some pretty significant restrictions on how social media companies can make money. Well, if you had 3% of your portfolio in Facebook or something, if you lose half the value, your portfolio damage is 1.5%. I mean, that's noise. Like that's really not a big deal. If you had some huge outsized position in it, well, yeah, that could be a real problem. So I think the best way to navigate this is just be smart. Don't overweight your positions, and don't overweight sectors. Having a portfolio, a diversified portfolio of Facebook, Twitter, and Google, well, that's not really a diversified portfolio, obviously. You need industry diversification as well.
Charles, you talk about in your website liquid alternatives. Can you kind of go through what those are? And do you have any baseline recommendation for individuals in terms of what their, I guess, liquidity threshold should be?
Yeah, sure. So liquid alternative can mean a couple different things, but for me, it simply means a strategy that is not a buy and hold stock market strategy that is also liquid. And what I mean by liquid is you can get your money out within a month. I mean, I think that is important. I think, it's okay to lock up a portion of your assets. That's fine. I mean, we're on the annuity show, for crying out loud. I mean, it's okay to have some money locked up, but you don't want to have all of it locked up. You do want to maintain liquidity in case you need it, right? So I'm a big believer in running strategies that you can access, you can get the money out if you need it, but importantly, sort of zig when the market zags. And, for example, an active trading fund, a long short fund, things like this, these can make money in an up market or a down market. Now, over time, just dumping everything into the stock market, buying and holding and letting it rip, has proven to be a good strategy, but it may not be a good strategy in any particular 10 or 20 year window when you need it to be. So let's say, you're retiring next year and you're depending on that, those buy and hold returns continuing indefinitely, but they don't. Let's say you're entering a period like 2000 to 2013, where the market went sideways for that period, or, 1929, 1954, where the market went, it took a long time to actually see returns there. Having some active strategies in your portfolio where you're hedged, or you're running a long short, but or whatever, just things that are not completely dependent on the market rising, that only makes sense, particularly in an era where, before you could just depend on bonds. So you had your stocks, and then you had your bonds that served that purpose of reducing volatility and also giving you a return. Well, the bonds can still reduce volatility. That's fine. That hasn't changed, but they're just going to drag your returns down to some extent in this environment. So having some active strategies in there can kind of do the same thing bonds were doing in terms of volatility reduction, but also give you a return.
Yeah, so we've had a lot of discussion in 2020 about annuities as an asset class. Charles, where do you fall in that? And just real curious, where do annuities fall in recommendations that you're making to your clients?
Well, the best thing about an annuity is that you dump the risk onto someone else. And it really is that simple. When you're running your own stock and bond portfolio, you always have reinvestment risk. Your bonds mature and you roll that money into new bonds, but you can't control what interest rate you're going to get. You are completely at the mercy of the market on that. So the nice aspect of annuities, depending on which ones you buy, what product you're looking for, is you can get a guaranteed payout in some cases, and the risk of providing that is on someone else. You have offloaded that risk to a third party, and it then officially becomes their problem. So I do like that element. In a lot of ways, they provide the security that pensions used to provide when a lot of Americans had pensions. So I think they're a useful part of that mix. Where I would say you don't want to put your entire nest egg in them, obviously, is just that liquidity issue. In some cases, let's say you have unforeseen reasons for wanting to get money out. You may want to do that without paying a surrender charge or whatnot. So yeah, I think some balance is nice there.
So Charles, how do you look at annuities in your practice as a registered investment advisor? And do you look at them through a different lens, and how do you talk to your clients about them?
Yeah, I don't do a lot of annuity business, but I will have clients come to me and say, "Hey, I have this annuity from my my employer brought someone in and gave a speech, and I decided to sign up for it." Or there's any number of reasons why people come to me with annuities, and I'll tell them, "Look, we can work this into the mix. I think this is fine. This can really be a substitute for fixed income." So, someone has, 20% of their portfolio in an annuity product. And it depends on annuity is a broad term. It could be a fixed annuity, variable. There's different animals here. But depending on how that annuity is structured, you can make that sort of a bond substitute. It can be part of that portfolio that you've dedicated to fixed income, for example. That's how I've used it for a lot of clients.
How about as it relates to clients that you work with that either have a pension from an employer or those that do not have a pension? Do you view the need for an annuity for those that do not have a pension as much greater and as a substitute for the lack of having a pension?
It really depends on how big the pension is. So if someone has a pension that pays for 50 to 70, or that pays out 50 to 70% of their prior earnings, they probably don't need an annuity at that point. Like that pension is getting the job done. They can just put the rest of their money into the stock market or whatever and be fine. I would say the annuity is an interesting product for someone that either doesn't have a pension at all, or they have a small pension, something that pays, less than half of their prior, their prior earnings. You could use something like an annuity to sort of bridge that gap.
But first of all, I just want to say, it's great to hear you talk about your approach to annuities, because it's open, it's thoughtful, right? This is very clear definition of where an annuity has a role, where it doesn't have a role. I think, from my perspective, and I assume that Paul, Mark, and William feel similarly. I think it's simply that level of discussion that would be great to see more of in the RIA space, instead of there being sort of like preconceived notions, but it's really a discussion about, it's a tool. It has it's a certain kind of hammer. It's good for a certain kind of nail. Those are the kinds of conversations that we all want to have. So I would ask, so what are you seeing in your broader community? So you have a very terrific and open mind about it. Do you think that's a trend that's increasing among RIAs, or is your attitude one that's more unique than we would hope?
I don't know. I'd like to think I'm original, but one of the things I have seen is the transition away from the broker-dealer model to the independent RIA model. In some ways, it's good for allowing for more open-minded. Well, let me back up for a second. So when you work for a broker-dealer, you don't necessarily have as many choices as you would like. A lot of times, as the advisor, you'll have a menu of approved managers and approved products, and you're sort of expected to kind of, stay there, right? When you're an independent RIA, you can do whatever you want. I mean, I joke, really the regulatory rules for RIAs is don't lie, don't cheat, don't steal, and the rest are just kind of details. I mean, I'm exaggerating. You do have to have a compliance regime in place, but it's not strict. I mean, so long as you're, as long as you're doing the right thing, you're not going to have problems. One issue, though, that even though you have a lot more flexibility, there are certain products you actually just can't sell. And a lot of annuities are tough for independent RIAs. They don't have a mechanism to sell them. They're not tied to a firm that's licensed to sell them. So I would say this overall shift in the industry towards more independence, in some ways it's good because it gives advisors the ability to think and use their own mind and not just toe the company line. But it can be harder to execute on it in some ways. So I'd say it's a mixed bag.
So, Charles, we do have a number of people at carriers who are responsible for product management listening to this. What would your recommendations be for a product product roadmap for 2021 and beyond?
So I think if you're trying to appeal to that independent RIA, you're trying to make a product that they can use, right? You have to reach out to their custodians. At the end of the day, the independent RIA is usually kind of understaffed and flustered, and just they need their process to be easy. They need it to be just streamlined and easy. So if they're at whatever custodian they use, whether it's, I don't know, Schwab, TD Ameritrade, E-Trade, whoever they're using, if you can work with their custodian to make it seamless where, their clients can log in and see everything in one place, I think you'll see a lot more acceptance. And I know that's not easy because you're introducing these other third parties there, but I think if you're looking to get the RIA on board, the last thing the independent RIA wants to deal with is just another set of paperwork and another portal to have to log into. And when client John Smith calls and says, "Hey, I forgot my password." Well, which one? Your TD Ameritrade password or your annuity password? I mean, when you have stuff at 10 different places, it's harder to keep track of it. So, having it kind of all under one roof, to the extent you can do that, does make life a lot easier.
User experience matters. It matters everywhere in our life these days. It's incredible. So I want to go back a little bit about what you were saying about the breakaway trend. We talked a little bit about it in prior to the call. Like, do you think that is going to be a continuing trend, that more and more RIAs are going to be breaking away, and why you think that is, and why might it be better for consumers as well?
Yes. Have you gotten an email from a financial advisor, and then the email itself is like 50 words, and then there's like 500 words under it of assorted disclaimers and, yada, yada, yada. It's ridiculous, right? So, everyone has to do their disclaimers. I get that. But what you end up with in the broker-dealer model is, because broker-dealers have not always kept their noses clean in the past, they're now hyper vigilant about making sure everything is exactly, by the letter, by the book. And so the unintended consequence of that is it's really hard to do anything in that model. So a lot of reps, registered reps or broker dealers are just constantly frustrated that they can't do what they want to do. I want to send my client a letter. No. We have to approve that first. It has to go through channels. I want to, host a dinner for my clients and give a presentation about my favorite stocks. No, you can't do that. And so you get into this it's a nightmare, right? And so once you reach a critical mass, nearly everybody wants to go independent at some point because, for one, they get tired of sharing their revenues with the parent company. And two, they just want to run their business. They want to be able to do something without being told no all the time. And so, I think this is a one-way street. I don't see anything really stemming this tide. I just see it continuing.
And is technology helping you get there? Like, is that sort of another key part of why this trend can happen successfully?
Yeah. So if I was running my practice, the same practice I have now with the same base of clients, if I was doing all of this 15 years ago, 20 years ago, I would probably have to have at least 2 or 3 more staff members just to deal with paperwork, right? That would be a necessity. I would not be able to function without that.
Yeah.
Today, that's just not really necessary because I can't remember the last time I actually signed a document. DocuSign now, right? You just send things that way. You can automate things. You can, when it's time to do your annual disclosures and all that good stuff, you can send a mail merge. What used to take hours or days can be done in minutes or like an hour or two now. Yeah. So yes, technology has been a massive game changer. Speaking of, one of the best things for the just the aspiring independent RIA is 20 years ago, there really weren't good block trading systems. You had to trade each client's account separately. And, if you have 200 clients or something, just buying one new stock might take you all day. Now, virtually every custodian you can use has really great block trading tools where in seconds, you can buy whatever stock, just pick one out of a hat, Apple, Amazon, whatever, and just push it down to all of your clients instantly. So yeah, technology has made it so much easier to go independent, and that's not changing either.
Yeah, no, recurring theme is technology. And Charles, I know you got a specialty in alternative assets, and which, I know as people looking for yields become more and more important, how do you do it safely? I was kind of blown away the other day to read that Mass Mutual, a 150, 200-year-old firm, will actually went out, I think, bought like 100 million. The press release, I think, or story said $100 million in Bitcoin. Charles, is digital currency at a point now where you think it's got enough stability or enough legitimacy to be an asset that somebody would want to put in a long-term portfolio?
Well, we're about to find out. I think we really have gotten to that point. It's funny. How do you describe this? Why do some artists become famous and rich, and other artists labor in obscurity and die broke and penniless, and nobody ever appreciates their work? It's just perception, right? And right now, there's a perception that cryptocurrency has value. Nothing has changed. Cryptocurrency was around 10 years ago, but acceptance wasn't there. There was not a perceived value. It was just sort of the domain of, I don't know, kind of, the eccentric. It was not, now it's very much mainstream. And the more mainstream it gets, the more mainstream it gets. The more people that consider it an asset class, the more likely it is to actually become an asset class. And so lately you've had institutional interest. Now, the banks might talk their book from time to time. When you do see the big boys talk about making cryptocurrencies kind of a proper asset class, that probably means they already bought it and they're talking their book, right? But I do think that we have reached a threshold to where, probably, you will definitely, well, there's no probably, you already are seeing this pop up in model asset allocations. It's small, call it 1%, 0.5%, whatever. But 1% of the trillions and trillions of dollars in investor capital, that's still a really big number. So I don't know where Bitcoin goes tomorrow. Your guess is as good as mine. It is a roller coaster, to say the least. But I would say it is safe to assume it's gone mainstream. I mean, already you can get it on PayPal and Square and Robinhood and everything else. It's just a matter of time before it's at every brokerage account in town.
And there's the neighbor effect that you mentioned earlier, right?
Yeah.
Guy's or woman's neighbor buys it, does really well, and suddenly they feel like they're left out, and then and things change. Yeah.
Well,
FOMO.
it's acceptance. It's 1 minute it's just, well, that's weird and eccentric. I don't know what that is. But then when everybody's talking about it and it has respectability, it's something that is people talk about in polite company, not just in whispered hushed tones. Then yeah, I mean, at that point, the market gets a lot bigger, and that's what we're seeing.
Mark,
Yeah.
what does a suitability form look like to sell Bitcoin?
Gotta be pretty long. Well, you could answer that one.
Well, I mean, just think about it. I mean, I don't think we're at that point, but there was a time. Remember when you had to be, have a certain net worth to buy REITs and whatnot. I mean, it's going to be an evolution, just like we've seen with everything else. But I agree with you that there's a conversation happening right now. And people here, they talk to their peers and whatnot, and sooner or later, someone's going to say, well, a percentage of my asset allocation model is in Bitcoin or some iteration of it, and someone's going to say, ooh, that sounds like I need to diversify, and it becomes kind of a self-fulfilling prophecy. But I do think, yeah, you say 1%. I mean, that's an approach that not everyone should, just like you said, you shouldn't put all your money into annuity. It's one of those things that becomes a balance and an allocation and a conversation.
Yeah. And 1% of multiple trillions of dollars is a big number.
Yes.
That's a lot of buying.
It's a lot. So we've really covered the waterfront. So Charles, love your perspective on politics and the shockingly low impact they have long-term in the marketplace, as well as where annuities fit and don't fit in people's long-term retirement portfolios. Mark, Will, Ramsey, any final questions for Charles?
Charles, one quick question. I'm sorry. So you founded Sizemore Capital in 2008. How much influence did the market correction during that period of time have on your decision to found it, and also your strategy of alternative asset classes?
Well, it is funny. My timing could have been a little bit better. I started the company in March of 2008, just months before the world blew up. So I like to think I'm a survivor. If you start a financial firm in 2008, and you're still around, a decade later, then I guess you're doing something right. I don't know. But how did that affect my decision to focus on alternatives? It was a big factor. It was absolutely a big factor. And it's funny, it started almost more with bond yields than with stock volatility. It seems almost silly now, but back then when bond yields cratered, I thought, well, look, you can't, bond yields can't go lower forever. We need some alternatives to sort of balance out that portfolio. And, it's more true now than it was then.
So wanted to say thanks for coming on. I really appreciated your thought process around breaking away in independence, around thinking broadly about different asset classes. One of the things we didn't get to that we talked a little bit ahead of time that I thought was very interesting was, how you think about talking about stocks as part of the way you market your business, because it was interesting because it wasn't really an asset management question. It was a credibility question. So if you can talk just a little bit about how that's been a very valuable to you in growing your business, that'd be great to hear.
Oh, sure. So it's funny when you publish, when you put out a lot of material out there and you actually give a real opinion, you say, hey, I like this stock. I own it in my portfolios, and this is why. It gives you credibility because people see that, you actually eat your own cooking, and they see your thought processes. When you give like generic marketing literature, it all looks the same. I mean, people, oh yes, I care about risk-adjusted returns. Well, who doesn't, right? When you publish something, like they're actually seeing the way you think, and they're seeing a real, authentic opinion, right? And people appreciate that. And so I've gotten a lot of calls from articles I've written. Someone said, hey, I read that article you wrote about, company XYZ, whatever. And that's really interesting. And then that starts a conversation. They don't necessarily throw down money that day, but you're on their radar. It starts a conversation. And then next thing you know, weeks or months later, they're ready to sit down and discuss being a client. So I think more than anything, the struggle for any advisor, when a client sees, the advisor with this little briefcase coming up, they just want to run away and hide because they assume you're going to sell them something, right? So when you give them that authenticity of like, I am providing you something of value. Here is an article I wrote where I'm talking about why this stock is good and why it belongs in your portfolio. You've already given them something of value and asked for nothing in return. You gave it to them for free. And you also kind of established your credibility and your authenticity. That helps, when the time comes to actually close the deal, they're ready to go. They trust you. Like they believe in what you're saying, and you don't really have to sell them at that point.
All right. Thank you for that.
Yeah, I want to thank you, and I also echo the sentiment that you made about the authenticity importance of that. And we've heard from other guests that how critical that is. And I liked your phrase, "You eat your own cooking." So I mean, it's showing the clients that that you're doing what you're potentially suggesting for them to do. So you've done it. So really appreciate you coming on the show, and your perspective, unique perspective, was very, very helpful for the guests.
Thanks for having me.
Hey, Charles, thanks for being on here. If people want to find you, Sizemore Capital, correct? We'll put a link in the show notes if they want to find you. Thanks for your time, Mark, Will, Ramsey. Thank you, and thanks for listening to our show. If you like our show, tell your friends and give us suggestions for guests. And join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.